Welcome back, traders. This is the second video in our market structure series. Today, we're going to talk about price action, which means how the price moves in the market. I'll be showing you a diagram to explain what an impulse and a correction are and why they matter. First, let's talk about an impulse. An impulse is a strong move in the market. It's a big, quick move in one direction. The price moves sharply up or down, showing a strong trend. Now let's talk about corrections. A correction is a small move in the opposite direction during a bigger trend. Corrections are important because they can help us find good times to buy or sell. Understanding impulses and corrections helps us see market patterns and make better trading choices. Let us imagine the market suddenly drops with lots of momentum, a big move down. After a big drop, we see a correction. During the correction, the market slowly moves up. It's a pause, not a trend change. Once the correction ends, the market often makes another strong move down. Looking at higher time frames helps us see the overall direction of the market and big levels where the price might change. When we combine this with lower time frames, we can find better points to enter and exit trades. This helps us make better trading decisions. Let's look at a weekly chart. First, we see a big drop in price, making a new low. After such a drop, the price usually goes up a bit before dropping again. This small rise is called a pullback, which creates a lower high before the price drops to a new lower low. Right now, the price is slowly moving up. When it reaches a certain level, it will likely drop quickly again. On the weekly chart, this move up looks bullish, but on the daily and 4-hour charts, it will turn bearish, as shown in the diagram. By diving into the monthly chart of GBP/USD to understand its recent movements. As we examine the chart, we notice the creation of new lows and highs. Recently, there has been a significant break of structure to the downside, resulting in the formation of new lows. This was followed by another break of structure, accompanied by a strong, impulsive move downward. To better visualize this, I have marked the significant highs and lows on the chart with blue color. These markings help us identify key areas to watch as we wait for the market to return to our zones of interest. Keep in mind that the price will likely move slowly towards these zones, reflecting the correction phase we've discussed previously. Here, you can see the break of structure clearly marked on the chart, indicating where the market dynamics shifted. Now let's look at the weekly chart to see how the correction phase works. Watch how it makes highs and lows as it moves slowly towards our point of interest. See how it broke the previous high and then continued to rise slowly. As I show you the highs and lows, notice how it reaches our point of interest. At this stage, it will start taking out all the highs and lows created during the correction phase. Now, let's focus on how it breaks these levels. Pay close attention to how it drops quickly and aggressively. You can see that we have hit a new low, breaking the previous lows and creating a new lower low. This part of the analysis is important because it shows the market's behavior during a correction phase. By understanding these movements, we can better predict future price actions and make informed trading decisions. Now, I will show you how we can catch the moves when the market is in a correction phase. Let's jump into the daily time frame and mark our points of interest. We'll focus on identifying both short-term and long-term buys as we navigate through smaller structures within the daily time frame. First, we need to mark our point of interest. We're looking for how we can catch the move to the upside. To do this, we'll use the Fibonacci tool to identify the imbalance area at the 50% or 79% level of the Fibonacci retracement. You'll learn more about this in upcoming videos. For now, we need a pullback to create another higher low. This setup will help us identify a strong buying opportunity. I showed you how to find point of interest using a rectangle box. This will help you understand how prices move in the market. We talked about how prices goes up and down, and how to spot important patterns like highs and lows, and when the market makes higher highs and higher lows or lower highs and lower lows. You'll learn the full strategy in the next videos, but for now, let's focus on finding these key points. As I mentioned, the weekly time frame is moving up during the correction phase, creating higher highs and higher lows. On the daily time frame, we can see the price moving slowly toward our weekly point of interest. Once the price taps into the weekly area, it often falls aggressively from this point. This is where institutional or banks come in with huge volume, causing the price to drop and create the next low. Now, let's mark the highs and lows on the daily time frame using yellow color, and where we can find opportunities to buy up to the weekly point of interest and sell from there. Remember, buys are for the short term, and sells are for the long term. As you can see, when we move to smaller time frames, everything looks messy and confusing. Personally, I prefer to analyze charts on higher time frames because it works better for me. I enter trades on lower time frames. This strategy works on all time frames. Supply and demand is a very strong strategy, and understanding market structure is key. Focus on market structure first. Learn how price moves with impulse and correction. Use a combination of time frames. Practice in the live market, and you'll see how effective it is once you understand market structure. That's all for the second video.